Hi, everyone. This is Jason Bjork of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for months. He works very closely with Samantha LeDuc over at LeDuc Trading. He's currently the macro advisor for LeDuc Trading. He also has a long career as a financial professional, 20 plus years as a professional trader, and a former hedge fund manager at well-respected hedge funds. Craig Shapiro, thank you for joining me.
Pleasure to be here. Thanks, Jason.
So, Craig, we're recording this interview on Tuesday, May 7th, 2024. The dollar index is at 105.37. The 10-year US Treasury yield is down a little bit. It got as high as, I think, 4.7. It's down in the last week or so, down to 4.46. I think the market's hoping for rate cuts and quantitative easing again with the low jobs numbers. I want to get your thoughts, though, on policy for the Federal Reserve Bank right now. Do you think the Federal Reserve is trapped and that they have no good options?
Yeah. So when I think about the Fed and what they're trying to do and how we came into the year, I do think that the Fed has made a series of mistakes, really since the beginning of the tightening of policy back at the end of 2021 and in the early parts of 2022. And I think they, kind of by focusing so much on interest rates as the primary tool, as opposed to using the balance sheet more aggressively, I think they've created an economy and an environment that just makes it very difficult for them to actually bring inflation back down to 2%. So what I mean by that is, they have been aggressive in raising rates over the course of the last couple of years. They moved policy up by 550 basis points over a short period of time. And they pat themselves on the back for that, as this is amongst the most aggressive tightening campaigns that we've seen from the Fed. And that did go and help bring inflation down from, core inflation was running at the peak in the high sixes, low 7% camp, and headline inflation was above 9% at one point. And so, through the course of 2023, there was some serious progress made returning inflation, lower, but really never getting to 2%. And so when we look back to the fourth quarter of last year at the September-October period, the Fed still was expecting to raise rates one more time in the fourth quarter of 2023, but the bond market was selling off, term premiums were rising, the equity market was selling off for a variety of reasons. And so the combination of the Fed and Treasury at that point and late October, early November basically pivoted. The Treasury announced that they were going to sell less in duration bonds, and the Fed basically said that they're not going to deliver that last rate hike. And so the combination of those decisions led to a significant loosening of financial conditions. And I think this is something that the Fed continuously misses, is they don't realize how quickly a loosening of financial conditions actually gets back into the economy through the wealth channel, through inflation expectations, through the psyche of consumers and home buyers. I mean, we see immediate reactions in the economy when financial conditions loosen as materially as they did. And we went from going from the Fed still going to hike to the market pricing in 7 rate cuts in 2024. That had a very significant impact on the economy, kind of led growth to come in higher than expected. The labor market stayed stronger than expected, and inflation bottomed in, call it November, and has been reaccelerating ever since, really 4 or 5 months in a row of really kind of getting better inflation data. And so we're now in a situation where we have inflation that continues to run above target. The economy is, slowing at the margin, and certainly there are segments of the economy that are more impacted by these higher rates that are hurting more than others. Right? We talked about consumer getting hit, credit card delinquencies rising, auto delinquencies rising. But Neil Kashkari from the Fed was out today just talking about the reacceleration in the housing market and how rental rates are starting to pick back up again, and home prices are not returning back to target. So there's housing inflation, there's services inflation. And so, the Fed has created this environment where if they were to cut rates now, they would reignite animal spirits, inflation expectations would move higher, the dollar would weaken, commodity prices would move higher, and that would, I think, virtually assure that we would not get back to 2% inflation. And on the flip side, if they were to raise rates again, basically what they're doing is they're further hurting the consumer, who is, particularly the low end consumer who is already kind of tapped out. But they're providing, these interest rate, they're allowing for an increase in interest rate stimulus checks to be paid by the US government that has, continues to borrow at ungodly amounts. And so, all that increase in interest expense goes and pays to rich households who have borrowed long term during COVID and sort of locked in low borrowing costs. So they're net benefiting from these increases in interest expense. And some of the largest companies in the world, big tech companies that have hundreds of billions of dollars of cash on their balance sheets, are also investing that money in U.S. Treasuries and T-bills and whatnot, and so are able to capture better earnings from that interest income. So yeah, the Fed is kind of damned if they do, damned if they don't. Cutting rates is going to lead to more inflation, and raising rates is probably not going to lead to a very quick decline in inflation without kind of causing a much more adverse impact to parts of the economy that are already struggling. So good job, guys. They really, I think, have created a monster here.
And what I see the Fed has done with the pace of the rate hikes, like you said, they've created, I guess, the central bankers, because a lot of them are Keynesians or neo-Keynesians. They're not MMTers yet, although they're starting to adhere to that. They're a lot of MMT people are starting to get like consulting gigs and present at think tanks here in the DC metro area, but they think that they can kill demand. But when you raise interest rates to those levels, Craig, you also are going to kill a lot of the supply side. So a lot of these commodities producers are cost of capital, borrowing debt, using debt to build a mine or borrow, or even if you're a farmer and you want to go borrow fertilizer or borrow capital to pay for fertilizer so you can grow your crops, so you can take advantage of those higher cocoa prices or something, emerging market. That's not happening now because of cost of capital and borrowing costs.
Yeah, I mean, it's really a problem. And I think maybe, if I were to give them any credit, I guess what you could say is, look, they did the right thing by stimulating the economy during COVID, bringing rates down to zero quickly, increasing the size of the balance sheet by $5 trillion over the course of 2 years. That went on too long, but let's say that they needed to do part of that. And they obviously encouraged aggressive fiscal spending, through the economy. And so, really encouraged, the deficit spending that we saw in 2020 and 2021, 2022. The problem is that we have not moved rapidly enough to remove that accommodation. And so what has gone on is basically inflation has become much more entrenched in the public psyche and in the narrative of the investing public and in the economy at large. And so they just, by not removing the liquidity and not removing the accommodation and letting it kind of fester for 2 years, we're seeing some of these adverse impacts. And to your point, these higher rates are discouraging on the margin companies from investing aggressively in capacity additions that may lower overall goods prices, right? I mean, we are certainly seeing CapEx go into chips and into the AI channel, but away from that, we're not seeing an increase in energy CapEx. We're not seeing really an acceleration in mining CapEx. And kind of broad equipment CapEx. So because cost of capital is an issue. And so by taking rates so high, we're not going to get the needed supply responses on the goods side that could help lead to a sustained low inflationary environment. And on the demand side, by bringing rates so high, the private sector, broadly speaking, has done okay. It's the government sector that has, not that they've struggled, it's just because they just print money. They just bring out that incremental interest expense and pay it out to the public. And so we're running, 6% of GDP deficits that are 6% or more of GDP, with GDP at 120% plus. The levels are just enormous. And so interest expense has gone up hundreds of billions of dollars, and that money is continues to filter into the economy. And so when you hear the Fed talk about their bewilderment about why growth continues to outperform, why inflation continues to outperform, and they don't talk about the elephant in the room, which is the fiscal spending, it's really it's either naive or it's gaslighting. And I suspect it's not naive. These guys are smart. They understand it. And so they're just basically gaslighting the public and not acknowledging that these deficits are having these kinds of impacts. And so, I think it's a real big challenge. And I think what the Fed probably thinks that they need to do now is just keep rates at the current levels for an extended period of time. And so at the last meeting in March, the last SEP, which is the forward interest rate forecast, the median member was looking for 3 cuts for 2024. The mean member was looking for 2 cuts. I think what we're going to get at the next meeting is a Fed that is looking for no more than 1 cut this year. And I'd say probably, 6 or 7 members are going to be looking for 0 cuts. And I think that they need to basically allow the economy to just kind of operate as if there's going to be no change in the interest rate environment for a very long period of time. I think what that would do is that would at least give folks, some comfort that policy rates are not moving higher, but also, they're not moving lower either. So if you're a company and you know that demand's okay, you're like, okay, this is the cost of borrowing for the next 12 to 18 months. I can lock in some borrowing costs here, invest in my business. And on the flip side, if you're, a consumer, maybe you could use this opportunity to say, look, I've been waiting to get into a home. At least mortgage rates aren't moving higher on me. Like, now's a good time. So I think that stability would be helpful for the economy. And so maybe that's what the Fed is trying to do. But I don't know that they are. Maybe I'm giving them too much credit for being smart in this, with that outlook.
Would you say that more of these record budget deficits are they actually the capital that the U.S. federal government is borrowing and then spending? Is more of that capital actually going into the real economy this time, and that's causing what inflationary expectations to rise? So, say for healthcare or other things with the transfer payments with Medicare, Medicaid, the other goodies that Biden has been handing out, I think over 150 billion as student loan debt bailouts in the last 30 or so years. It's been disclosed. I mean, he was talking about it during the State of the Union address. So more of that capital being spent by DC is actually hitting the real economy.
Absolutely. I mean, basically, it's the velocity of the money that is creating the inflation, right? You're giving these transfer payments to lower and middle income Americans who kind of need that money and turn that money over much more aggressively. And also the government pays out these high rates of interest to borrow to the household sector and to the corporate sector, and they're using that money to redeploy back into either assets or the real economy. So yeah, I think this time the deficits they're just enormous, right? We're at full employment, we have inflation that is running above target, and the government is spending 6 to 7% of GDP in excess of what they bring in. So these are historically high levels of deficit spending for an economy that is not in dire need of that level of accommodation. I mean, even back in the late 70s and early 80s, with that inflation that Volcker had to tame, deficits did not get to these levels. And so we're consistently running 5 and 6 and 7% of GDP deficits in 2022, 2023, and then again in 2024, when the economy has recovered from COVID. I mean, we are well past the point where this economy needs that level of accommodation, and yet there is no appetite in DC from either side to get the budget more in balance and to slow down the deficits. Right? There is no desire to raise taxes, and there is no ability to cut spending from either party. So, it's real dysfunction. And because of that, and because the Fed has come in to save the bond market at various times over the course of the last 5 years, there is no repercussions to this behavior in DC. There is no bond vigilante. There is no discipline metric on Congress and the administration. And so they just borrow and borrow and borrow. And if and when volatility rises and yields move too high, the Fed just comes in and says, we'll help out. And so, ultimately over time, that is weakening the value of the currency, deflating the dollar versus hard assets, and will eventually lead to, a further flight from foreigners' ownership of our bonds. but that is playing out over a series of quarters and years rather than days and weeks. So it takes time, but ultimately, yeah, I think that's the part that is the main part of the reason why inflation is not easily returning to 2%.
Well, you also have, with the amount of money that was printed by not just the Fed, all these other governments from 2020, 2022, you have trillions of dollars, but then that creates inflationary expectations. And then workers in certain industries want higher wages. So that's what a wage price spiral. You have companies then that want to raise prices to offset higher costs or offset higher wages. I mean, I guess there's a limit to that with profit margins, and they may ultimately mean revert if companies can't keep raising their prices. But that just means that the economy is going to have higher price levels for the companies to maintain their profit margins.
Yeah, Barkin from the Fed gave a speech yesterday where he talked about how companies are using the price lever way more aggressively today than they did prior to COVID. Now, their success in pushing prices has started to, come down a little bit. Over the course of the last 2 years, right? Companies raised price and no one cared, right? It's just price went up, price went up, price went up, and so there was, tremendous pricing power that moved through inflation. Now it's a little bit harder for companies to get those price increases, but they're still trying. And so, to me, that's the definition of unanchored inflation expectations. When companies are telling you they're just going to keep trying to raise price and generally can keep raising prices. And so then consumers basically can come back in and say, look, my prices keep going up. I need to earn more from my job in order to keep up. And so I think when folks think about a wage price spiral or they think about stagflation, they go back to what was seen in the 1970s and early 80s, let's say, when we had double-digit rates of inflation. I think it's important to keep in mind that back then government debt to GDP was 70% less than it is right now. We were in the more like the 30 to 40% camp. Deficits were 2 and 3 and 4% of GDP. We're running 6 and 7% now. And the net international investment position of the U.S. back then was positive. We had net surpluses overseas. Now we have negative to negative 70% of GDP position right now. And so even though wages are not moving up 8 and 10%, that 4 to 5% level is a problem in a society and in a government that has this much borrowing. And so, yeah, from an inflation point of view, if you have 3 and 4 and 5% inflation, that's equivalent to in a levered government, that's equivalent to what we had back in the 70s of 10 to 12% inflation. So this is a stagflationary environment where we have slowing growth and sticky inflation, and it makes it more difficult for the Fed to achieve their mandate of stable prices. And I think they are really struggling with that. I think they should be more aggressive using the balance sheet as a tool to assist them. But they are afraid. They're afraid of a banking issue. They're afraid of what happened in the fall of 2019 when there was the repo crisis. They're afraid that bank reserves are going to get too low and there's going to be a bank run. And so they continue to come in and provide liquidity when volatility gets too elevated. And so market participants understand that. And you saw the reaction last week to the Fed meeting when Powell came out and said rate hikes were not really on the table from his perspective. Immediately what happened was a loosening of financial conditions, reigniting animal spirits, inflation expectations moving higher as gold and crypto and stocks and credit spreads all moved in a positive way. And that just, again, makes it more difficult for the Fed to bring inflation back down to 2%. So they continuously do it. And, then they get surprised why they can't bring inflation back down to 2%. So again, it's my comment earlier. It's either they're naive or they're gaslighting. I think it's the latter. And it's discouraging as a citizen. So, but as an investor, we have to think about how to profit and how to prosper in this environment. And look, I think when the it's really what we're trying to do is we're trying to understand the levels where the Fed put is enacted, right? When is there enough volatility or strain or market disturbance to lead to the Fed providing dollar liquidity? And what we got last week, even though it wasn't a rate cut, what we got was from Powell talk about rate hikes kind of not being the case, and a tapering of quantitative tightening to lower the amount, the speed with which the Fed's balance sheet gets reduced. So on the margin, those are adding liquidity, and the market reacted as it always does, and it loves that liquidity. So that's kind of where we sit here at in the second week of May. With inflation running above target, we have a very important CPI print next week. And we'll see if we have another month of inflation reaccelerating. And then I don't know how the Fed's really going to handle something like that.
Well, I think the Fed is trapped, and I think the main issue is the supply and demand developing issue for U.S. Treasuries is that the budget deficits in D.C. are blowing out. The national debt is growing at a record pace. $1 trillion added every 100 days, and soon it could be every 90 days where $1 trillion is added if the spending pace continues. Because I think for their fiscal 2025 budget assumptions, they're not even assuming a very high interest payment on the national debt. So that's going to be added on. The budget deficits are still blowing out. But I want to ask you about what you think is the real mandate for the Fed, because when the Fed goes to when the Fed chairman, whoever it is, goes to congressional testimony, or other Fed governors go on business TV, they always say that they're focused on the labor market and price stability. But you said that the Fed has a different real mandate.
Yeah. So the Fed. So those are the Fed's stated dual mandates: is maximum employment and stable prices. And they also have a mandate about financial stability. And that is written into part of the law and part of their mandates, that they need to kind of create and maintain a stability within the financial system. But there's no specific numerical term around what that actually means. And so what I'm saying is, and what I've been seeing through their behavior, is that they have elevated that financial stability mandate to a primary mandate. Basically, whenever there is the U.S. Treasury market does not operate smoothly, they come in and do something. And the definition of what is U.S. Treasury market dysfunction is really, again, not necessarily known. But 5 times over the last 5 years, the Fed has interjected liquidity into the economy to save the Treasury market, when it wasn't clear that they were violating the maximum employment or price stability mandate. So back in the fall of 2019, what became later known, or at the time was known as the repo crisis, right? I mean, banks were having trouble getting access to liquidity in September of 2019, and all of a sudden, the Fed, that had been doing quantitative tightening, basically said, "Yeah, we're done with this." I mean, and it was over the course of like a few days. Treasury market dysfunction happened very quickly. Borrowing rates at banks went to like 9 or 10% for like a couple of days, and the Fed shit itself, for lack of a better word, and ended that first bout of quantitative tightening, because bank reserves had gotten to too low levels, and led to some banking issues. At the time, inflation was not an issue, running below 2%, and employment was not. There was no issue on the employment side either. So why did they interject? Why are they? Both of their mandates are being hit. There's really no issue. They interjected, obviously, again during COVID, and you can argue that there was there was good reason to do that, but they did provide a tremendous amount of liquidity, because in March of 2020, it was the bond market that was selling off with stocks, right? Foreigners were selling US dollar assets in order to raise dollars to pay down dollar denominated debts. And so there was a run on the banks. Run on the bond market. And that is what precipitated the Fed to go as aggressively as it did with quantitative easing, because the U.S. Treasury market was dysfunctioning in March of 2020. Fast forward again to October of 2022, UK gilt crisis, long into the bond market, moving, very aggressively. At that point in time, we're basically at full employment here, and inflation is running above target. What does the Fed do? Signal an interjection of liquidity, help to weaken the dollar, help to stabilize long-term borrowing rates for the world. So that again, operating as without really keeping in mind the dual mandate. Fast forward again to March of 2023 with the banking crisis at Silicon Valley Bank and others. Right, again, unemployment sub 4%, inflation running above target. Fed should be doing nothing. What do? They immediately inject hundreds of billions of dollars of liquidity to save the banking system. And then lastly, in October of this past year, in 2023, pivoting, not delivering that last rate hike in concert with the Treasury's decision, putting more liquidity back into the market, even though, employment is unemployment sub 4%, and inflation running above target. So this is 5 times in the last 5 years they have elevated the primacy of the smooth market functioning mandate for U.S. Treasuries above the mandates of maximum employment and price stability. I mean, for the last 50, last point, just for the last 50 years or more, when asked about what maximum employment would be in the U.S., people were thinking, I don't know, 4.5%, 5%, 5.5%. Unemployment in this country has been running in the mid 3% level for countless quarters, and yet the Fed even now is talking about the possibility of providing liquidity again for if unemployment rates move back up to low 4%. Like, why? I mean, they've moved the goalposts on that, and so I think that's an issue, and I think by continuously doing that, they are also enabling Congress and the administration to run these deficits that are absurd, because Congress and DC knows that if there's ever an issue in the bond market, the Fed's got their back, and so I think that's the reality that we are living in.
I think the point that you're also making is that these banking problems are becoming more and more frequent. I think a lot of the problem, too, is the leverage in the system with these trades. So when the Fed goes on a normal rate hiking cycle that they would have done in the past, I don't think there was the leverage ratios. And you were a hedge fund manager for a long time. I mean, didn't the risk parity trade in 2019, the last Fed rate hiking cycle, there was hedge funds, there was bank portfolio managers that blew up on risk parity on the basis trade. They were drastically over leveraged on those things. I believe the money market funds had loaned a bunch of capital into the repo market too. Didn't the Fed secretly bailed out, I think, a lot of these entities? Didn't those leveraged bond trades blow up?
Yeah, I mean, I think that happened in September of 19. It obviously happened again in March of 2020. Levered hedge fund players with basis trades on were blowing up during the uncertainty regarding COVID. And so, the Fed had to come in and kind of bail out these players. I mean, it's happened time and time again over the course of the last 30 years or so, dating back, or 25 years, dating back to the LTCM bailout in 1998, and it happened in 2000. It happens continuously. The Fed comes in when the banking system is under pressure, but most specifically when the U.S. Treasury market is coming under duress. And I think what we're seeing is, as foreigners are demanding less treasuries because they see that they're only being paid back in deflated dollars, or they're concerned about their reserves being expropriated, like the U.S. Has done to Russia and to other enemy states. I think as foreigners step away from the Treasury market, the frequency with which we have these episodes of elevated U.S. Treasury volatility are going to continue to narrow. Right, we're going to get more and more of these quote unquote shocks, and for the Fed, they ultimately need to decide: are they going to continue to just provide liquidity around every corner whenever there's a little bit of strain, or are they ever going to just allow the markets to price properly for a little bit, right? Because that will remove some of the moral hazard. That will remove some of the leverage from the system. I mean, look, obviously, if they wait too long, they run the risk of having a much larger issue. But when they barely wait at all, like for the SVB crisis, there was really no need for them to do what they did. Um, the quicker that they react to small fires, the more likely that we're going to have a bigger fire later that is harder for them to react to.
Well, the Silicon Valley and creating the BTFP, that was politically motivated. There was a lot of very rich people that had way above FDIC limits from Silicon Valley and Hollywood in Silicon Valley Bank. There was people that had tens of millions of dollars there way above FDIC limits.
Look, I mean, there is certainly a, high correlation to, when, having the government react when rich people are getting screwed or at the risk of getting screwed. And, basically, the Cantillon effect would suggest, the closer you are to the money creation, the better off you're going to be. And that works on the upside and on the downside too. It's you have the ability to impact the government and kind of force Treasury to change the rules or force the Fed to change the rules, at a much higher degree than 99% of Americans who have to deal with the repercussions of those decisions. And so ultimately, lower and middle class Americans are really suffering from the flawed policies of the Fed as the Fed placates the rich and elite classes in this country. And it's not clear to me that is really going to change anytime soon.
Yeah, I agree. It's a mess. Politically, it's definitely a mess. Also, just saw a Bloomberg article in the last couple of months talking about too big to fail hedge funds with over-leveraged bond trades.
Yeah, I mean, Ken Griffin, who runs Citadel, has been rumored to be a potential Treasury secretary, right? I mean, if Trump is elected. So, and clearly, Bernanke is a consultant for Citadel. I mean, and so the revolving door between the Fed Governor Kaplan, it just announced today he's going back to Goldman Sachs to be the vice chairman. I mean, so there's a revolving door between policymakers at the Fed and at Treasury with investment banks and with hedge funds. And so, they keep the party going for the people that kind of got them there. So, I don't know that there is anything that the public is going to be able to do about this dynamic. But what I do know is that there is a real trend away from foreigners demanding U.S. Treasuries and storing wealth in U.S. Treasuries over time. And so that is a trend that will continue. And look, it is challenging the primary role of the dollar as the global hegemonic currency, and it's challenging the role of U.S. Treasuries as the global hegemonic neutral reserve asset, and is reintroducing gold back into the equation where it's been, has been for thousands of years. I mean, central banks have been net buying gold for a decade and have been not adding to their treasury positions. Clearly, China and Russia are buying gold hand over fist, and we're seeing the flows of gold, from London, from Switzerland, from the New York gold vaults, and all moving east as gold is being reinserted as a neutral settlement asset for trade. And there is an alternative monetary system that is being created away from the dollar, and it's just a question of whether or not the U.S. wants to continue to fight that creation, or is the U.S. willing to, change its ways and become part of that new world order and currency system. And I think the jury is still out for now. That it does seem like the U.S. Wants to, keep its hegemonic status, and so I think that's why we continue to have these economic warfare type games, and there's some back and forth between the U.S. and G7 with, BRIC countries. But I think as gold continues to take share and continues to move higher, it's clear it's being reintroduced into the monetary order again.
And lots of currencies are also being debased. So the dollar on a relative basis is relatively strong. The dollar index is at 105.37, but a lot of other currencies, it looks like their governments and central banks are going to let the real inflation rate run hot, and they're going to do some type of yield curve control or financial repression where the real inflation rate is above the yields on government bonds. And then the other part of this, with the private sector, you brought up central bank demand for gold. I mean, private citizens, with people in China buying physical gold and silver, people in India, Japan, Asia. There's enormous demand for physical gold by regular people that are worried about devaluation of their domestic currency and are trying to hedge currency debasement. Now you're going to start to see some of these governments that are allies with the U.S., like Japan, which has dutifully bought post-World War II. They bought a lot of U.S. treasuries, way over $1 trillion of U.S. treasuries. And now it looks like Japan, to defend their own currency, they might have to start selling some U.S. treasuries.
Yeah. I mean, I think Japan has been at the foreground of, creative monetary policy decisions for, 25 years or so. But now they're getting closer to their end game. I mean, they want to be an active participant in global trade, and so they have to allow for free flowing capital in and out of Japan. So when you think about Triffin's dilemma, they can either have an open capital account. You can either deal with the capital account, you could deal with the interest rate lever or the exchange rate, but you can't deal with all three at the same time. So if Japan wants to have an open capital account, which it does, and it cannot allow interest rates to rise aggressively because government debt to GDP is already 270%, and higher rates would, basically bankrupt the banking system and the country. The only outlet that Japan has to deal, with these issues is weakening the currency. And so I think that the yen is going to continue to weaken. And the only question is, how quickly will it weaken? How quickly will it be allowed to weaken? And what they could do in order to slow down the degree of weakening, because Japan doesn't want it to weaken too rapidly, because then it would have imported inflation issues that could run away from them. So they are happy with a gradual pace of decline, but I don't think they are happy when it is an accelerated pace of decline. So when it does seem like it's accelerated, what they can do is they can sell U.S. dollar assets, of which they have 1.1 trillion in U.S. treasuries. And so they could use that to help slow down the pace of yen debasement. The issue is, they kind of have to go and remind Yellen that they could do that, right? And so, because Yellen has a lot of treasuries to sell also. And so if Japan is selling treasuries and Janet Yellen is selling treasuries, that's going to provide a lot of pressure on the long end of the bond market. And so, these interventions kind of need to semi be coordinated if they're going to work. But ultimately, Japan has to decide. They have these $1 trillion of assets overseas. If they want to improve their domestic economy and slow down imported inflation, the thing that they do is they need to spend down those excess reserves that they have abroad. And so I would anticipate that they are going to be sellers of U.S. dollar assets, for the next several quarters in order to slow down that pace of yen devaluation.
So in the U.S. Treasury market, I think there's been a record bond bear market for the last 2.5, 3 years with the pace of the Fed rate hikes. Do you think that there's going to be an even longer term bond bear market for government bonds, especially U.S. Treasuries, but maybe also other government bonds going forward?
Yeah, I mean, I think bonds have become certificates of confiscation again. I mean, they are going to continue to lose money in real terms. Every quarter, the U.S. government is net issuing $500 billion of bonds and notes, and that's at least for the end, through the end of this year, and then starting again next year. I anticipate that number is going to start rising again to 550, 600, 650, 700 billion per quarter. Right now, there is a mix of bills and bonds that is north of 20%. Historically, there's been a good range of the composition of the debt in the US would be between 15 and 20% bills and the rest bonds. Currently, there's about 23% bills and the rest bonds. And so if Treasury wants to move that back to its more historical range, they were going to eventually need to raise the amount of duration issuance to, above the 500 billion that they're doing now. So when you combine that fact with these accelerating deficits, we're going to be talking about 600 to 700 billion of supply of treasuries from our government every quarter from now until forever. So that's just a lot of money, right? And so it's not something that can easily be front run. It happens in when these auctions come every other week. And so there's just going to be a continuous pressure on the long end as more and more supply hits the market, and term premiums are going to continue to grind higher. I mean, historically, pre-COVID, term premiums, which is basically the additional compensation an investor desires for lending money long versus lending money short and rolling that over. So right now, those term premiums are in the 15 to 25 basis points camp, let's say. They're historically averaged about 75 to 100 basis points, and there's been times when it's been 150 to 200 basis points where investors have commanded 200 basis points more from 10-year yields versus 1-year yields rolled over. And then additionally, the yield curve is also still inverted. So short-term rates are above long-term rates. I think we're going to be in a situation where eventually the long end yields in the long end are just going to go materially higher. I would not encourage anybody to buy tomorrow's 10-year auction at 4.45%, which is where the 10-year is trading right now. I think we're going to be in a situation where yields on the 10-year are going to be, as we push through the year into next year, 6, 7, 8%, very easily.
Wow. And then that's going to, as we discussed earlier in the interview, I mean, when the 10-year US Treasury yield is at that's the quote unquote risk-free rate. A lot of discounted cash flow analysis for when you're planning investments as a private sector business, you model everything off the 10-year US Treasury yield. That's your risk-free rate. And then you start discounting off of that. I mean, you're looking at a lot of projects being uneconomic. So there's going to be a lot less supply, a lot less investment from a lot of private sector businesses if we get to those 10-year US Treasury yields that you're talking about.
Yeah, I mean, the government borrowing is going to crowd out everything else. And yeah, it's going to become more expensive for everybody else to kind of transact and participate in the economy until and unless the Fed comes in and stops it with yield curve control or more quantitative easing in order to bring those yields back down. But if they do that, like what Japan did and what other central banks have done in the past, the dollar is going to lose a tremendous amount of value against other fiat, but certainly against gold and against oil and against other commodities and other hard assets. And ultimately, I think that is probably the way this is going to go down. The U.S. government's not going to exist for very long in an 8% 10-year world, given the levels of debt and given the levels of deficits. But I think that kind of scare is probably what is necessary in order to bring about whatever this global monetary reset that I've been talking about and others have been talking or thinking about, I think will happen, but it will happen because of this violent sell-off in the bond market, at some point, whether it's this year or next year, I really, or the year after, I really don't know. But we're sowing the seeds for that type of trading, now by continuing over these deficits and not really doing anything about them.
Do you think the U.S. Treasury and DC wants a weaker dollar, but they want it managed? Because right now, the dollar index, it's starting to rally. If it keeps going higher, I mean, isn't that going to cause like a global margin call on a lot of dollar-denominated debt outside the United States?
Yeah, look, I think ultimately the U.S. needs a significantly weaker dollar in order to spur manufacturing activity in America, in order for America to rebuild its supply chains. Clearly, America's supply chains were greatly exposed during the COVID pandemic, and we just need to rebuild things here. We've been running behind, in munitions capabilities, in shipbuilding, in everything. And in order to kind of become competitive again, the U.S. needs a drastically weaker currency. And I think the rest of the world would be very happy to see that dynamic play out. However, there are risks to inflation if the U.S. does that too aggressively or too soon, as opposed to doing it. Someone described it today as like a controlled demolition. I think that they would prefer this to happen kind of, over time. So yeah, I think that if the currency were to depreciate very rapidly, we would have that inflation much quicker here in America. And it's election year. Folks are already pissed off about a lot of things. So if we got a very weak dollar between now and the election, and oil prices went back to 100, and gasoline prices were $6 a gallon a month before the election, I don't think anybody would be very happy. So I think I think the government recognizes that a weak dollar has become back in our strategic interest. And so trying to figure out the timing and the pathway to allowing that to happen without it igniting massive inflation again, I think is what they're trying to do. Whether or not they'll be successful, TBD.
It also looks like a lot of the manufacturing jobs are not coming back to the US, they're going to Mexico. So like friendshoring. So the factories that have left China, they're going to what? India, Bangladesh, and Mexico, not the US.
Yeah, I think this concept of friendshoring is something that I think, certainly makes sense. We can't build it all here, and we need, some of our friends to help us out, but we need to have a proper currency system in order to manage that. And we need to be able to have a government borrowing and deficit situation that is not egregious, that destroys the excess reserves that our trading partners have with us. And so we have abused this exorbitant privilege that we have. Foreigners are getting pissed off. They're starting to sell. They've been selling treasuries and will continue to sell treasuries, because there's no stopping these deficits. And so I don't know how the rest of the world is going to believe that the U.S. is going to get its fiscal house in order. And until we do, it's going to be hard to make real structural changes.
Well, in terms of like investing and ways to play this, it looks like the people in power aren't going to allow deflation, debt deflation, and asset prices maybe falling for a long period of time, because then that starts to muck up the tax receipts, and then the Federal Reserve Bank may have to step in and start to fund what government, again, buying U.S. treasuries, buying municipal debt like they did in 2020 after rules changes. The smart investors, like the hedge fund managers that have a really good track record, like Stanley, Druckenmiller, David Einhorn, they've started to sell some of their technology company shares like Nvidia, Amazon, Google, some of the others after they've already taken profits. And they're starting to reallocate asset rotation into like base metal miners like tech, oil, natural gas companies like Chevron, and then also gold miners. Do you think that this is probably this asset rotation of trying to buy low, sell high, and then moving into different asset classes is a smart long-term strategy?
Yeah, look, I mean, I'd still be a believer in the AI cycle. I just think, valuations are very high, and so and I think that valuations in commodity producers are obviously much lower and much more attractive. And so I do think that rotation makes sense. Kind of a paper to hard asset rotation. And yeah, we're starting to see, some early signs of that, but clearly there's a lot more to go. I do think that it's, the question for the Fed is how much of a mini deflationary bust will they tolerate in order to kind of sow the seeds that are necessary for them to do the next level of money printing. And the problem I think we're having is that the bubble is getting bigger and bigger because they keep hinting that they'll and acting like they're going to pump liquidity around every turn. So the market kind of calls that, sniffs that out, and reacts accordingly. And like I said, like we saw, over the course of the last week or so after the May meeting, and that's what gold is sniffing out, and that's what Bitcoin is sniffing out. It's that the Fed will never allow a debt deflation cycle to exist for very long, and that it will come to the defense of paper assets quickly with more liquidity. And so gold's front running that, and Bitcoin's front running that. And I think ultimately, that putting capital into the hands of producers who could benefit from that weak dollar environment with real assets like energy producers or copper producers or what have you, I think that is it is a smart strategy.
And I think the commodities index, so that's like a basket of different commodities. I think it's rallied over 20% since November, December. So I think it is sniffing that out, that a lot of these other countries, people in those countries are starting to buy inflation hedges. It's not just the US. I think the currency debasement is occurring faster in other countries because these other currencies are temporarily a lot weaker against the dollar right now.
Yeah, no, I think that's true. We're kind of in that situation. It's just like the dollar milkshake part of the trade, where we have dollar moving up against other fiat currencies, kind of in line with gold moving up, and that's because plenty of emerging market and foreign central banks and governments have still borrowed tremendously in U.S. dollar terms, and so need to, as the U.S. has raised rates and attracted capital because of high interest rates in America, and having kind of best in class equities and best in class companies, it's harder for some of these emerging markets to get access to the dollars necessary to pay down the dollar debts that they have. And so, we're seeing that weakening of various emerging market currencies versus the dollar. And clearly those currencies are devaluing even more aggressively against gold. And I think that's it's going to create an inflationary issue for everyone in the world. And so the question is, again, how serious is the Fed thinking about getting inflation back down to 2%? What are they willing to tolerate? Are they willing to tolerate a U.S. Treasury, a 10-year yield at 6%? Are they willing to tolerate a rise in the unemployment rate from 3.7 to 5%? We don't, I'm not sure, right? Because over the course of the last couple of years, they've reacted sooner than that for both of those, metrics, right? They've reacted to provide liquidity when the 10-year got to 5% as opposed to 6%. They reacted and they'll react. I suspect they're going to react when the unemployment rate moves to 4.5%, as opposed to, even though over 50 years of history, that would have been considered maximum employment.
The Fed has such a terrible track record, though. I mean, before the last housing bubble cycle, they were saying subprime is contained. I don't think they understood the problems in the mortgage-backed securities market, and that caused the banking system problems. The pace of these rate hikes, and then all the perfect storm, I would say, conditions for people working from home, the consumer now, a lot of consumers are tapped out with their savings being depleted, the amount of inflation, credit card debt. I think it's a perfect storm now for commercial real estate here in the United States, also Europe, and then the regional banks that have a larger percentage of exposure. So you add in the Fed raising interest rates to the lack of rents and occupancy rates with these office buildings. I think there's a banking system crisis brewing.
Yeah, I mean, it definitely feels like there's some larger issues that are developing, and something is brewing. But look, the question is, there are geopolitical considerations, and they are political actors that can alter the course and path of these events by changing the rules or doing different things. And they exist at the Fed, they exist at the Treasury, they exist at the ECB, at the PBOC, at the BOJ. And so a lot of these trends are in place, but there are human actors that could come in at different points to accelerate the speed of moves or slow them down.
Okay, so this is a discussion we had offline, Craig, over on Twitter, where you were telling me as a hedge fund manager that you don't know the problem's going to be first. So it could be commercial real estate, it could be problems with Japan and the yen, could be China devaluing the yuan or something else. So as a hedge fund manager, then you wouldn't bet on one specific probability playing out. That's kind of a fool or sucker's bet. You'd kind of want to weigh the probabilities on first, because you don't know what's gonna happen first, and then how like the politicians, people in the finance ministries, the central bankers are going to react to the first thing that breaks.
Yeah, I mean, we're looking for fault points, right? We're looking for the point where the plates shift and create, the earthquakes. And we know where to look. We just don't know what's going to break first, right? Clearly, the debt levels in Japan are a top of mind issue. Clearly, the deficits in the U.S. are an issue. Clearly, there are geopolitical risks in the Middle East with respect to oil flows. And if there were something that happened there that shut down oil in the Strait of Hormuz, let's say, for an extended period of time, like oil prices would rally 50% in a day, and that would have an impact. Clearly, China and Taiwan and how it, how that goes, and the treatment of TSM and chips in their factories, and a potential blockade so these are the places that we know to look, but human actors will determine the speed with which we get to those points, and kind of what happens first. And so, as investors, I think we could just kind of probability weight things and try to invest accordingly. And it depends on your time frame, right? I mean, if you're a day trader, or if you're a very short-term trader, you don't really necessarily need to be thinking about, all these structural things. But I think if you're a large family office or a large pension fund, and you're thinking about maintaining wealth and growing wealth on a 3 to 5 year view, you kind of have to, trade with the with the trend here. And the trend does seem to be one of sovereign bond yields continuing to move higher over time, as deficits spending are running way higher than expected and way higher than they should be. And so you're going to have, bond markets selling off. You're going to have fiat currencies in those countries devaluing versus hard assets. And so I think you trade with that as a tailwind, and you size up and size down your positions based on kind of where we are in some of the mini cycles.
Yeah, I agree. I don't think that trend's going away, because from 2008 to present, I mean, the amount of global debt, it increased by around 100 trillion. I think it was like 220 trillion in 2008. Now we're a little above 300 trillion now, 15 years later.
Yeah. Yeah.
And now there's too much debt. And then historically, I mean, like the governments, they have limited options of how to deal with that debt. So either they can do an immediate default, which is what debt deflation, they announced that they were taking a haircut on the debt immediately, or they inflate the debt away over time.
Yeah. Look, I think it just comes down to pain tolerance of the policymaker, and trying to determine where the level of the put is struck. And so it's an election year that has some interplay from the Fed and Treasury's point of view. Next year there may be a different administration that may change the reaction function possibly, but it's really a question of, at what point can the Fed come in and provide liquidity again? And in my view, I think they need to allow some deflationary forces with the market correction to happen in order to stave off the worst outcomes. And if they really are serious about bringing inflation down, then they kind of have to do that. But maybe they just want to run inflation hot for a long period of time. They think that we're going to grow out of it, and that productivity boom is just around the corner. And so why go the last mile when you believe, we're going to have some productivity immigration boom here? That's the opposite of what they're saying publicly. But so, you have to kind of believe that they're just lying to us. I don't want to believe. I don't believe that. So I think they just need to allow some risk-off behavior to come in, kind of bring down animal spirits, bring down, re-anchor inflation expectations, take a bit of the froth out of the markets and out of the economy, and then hopefully like rebuild a proper economy that is fairer, that has more, even wealth distribution, with a weaker dollar that returns manufacturing to America and sets us up well for, the next 5 to 10 years. That would be better. I think if they keep trying to run it like the way they're running now, we're going to have that second wave of inflation, like we had in the 70s. And I don't think that's something that anybody really believes is a good thing.
And with this supply demand issue developing in treasuries, I mean, the Fed's probably going to have to be the buyer of last resort of treasuries unless they stuff it into a lot of the banks. They change all the leverage ratios. I mean, Lynn Alden has talked about this, that's part of the plan, but the banks can't absorb all the treasuries. So it looks like the Fed's going to have to be the buyer of last resort soon.
Yeah, I think they will. And it's just a question of how, I don't think that happens with the S&P at 5,200. I would say some people probably believe it happens with the S&P at 4,900. I think it happened, but for me, I think it happens with the S&P way lower than here. So I just don't think we're anywhere close to that, that pain point yet. And I think we will, but I think we will trade there, and we will find the level that forces the Fed to come back in and buy the debt. So that is a trend that I think needs to be in consideration as we kind of transition through the rest of 2024.
But you said you don't think the Fed will will do a 180 and start expanding its balance sheet again until there's actual bankruptcies, say like more regional bank failures, and then asset price deflation, say there's a correction in major asset prices then?
Yes, that's correct. You need to see a very significant deceleration in labor force momentum and a much more sizable correction in asset prices that really tightens financial conditions. And I don't think we're anywhere close. Now we could get there quickly. We can get there over the course of, a 2 to 3 month period. If let's say inflation prints for the next week are way hotter than expected, and then Powell comes in and says, I was wrong, and we may have to consider hiking rates. And then at the June meeting, basically the median dot goes to 0, and everyone's like, holy shit, there's no cutting this year. The Fed's really scared about inflation, and maybe between now and then there's some more geopolitical angst that takes crude back up. And then all of a sudden, then the market's really in a box, right? Because the Fed is in a box. And that could lead to a pretty swift 15 to 25% correction in equities, and 50 basis point move higher in yields, the dollar rallying with crude. And maybe that would be the environment that the Fed feels like they need to do something about. But we're just not there yet.
Your wealth of information, Craig. I want to thank you so much for your time today. I've kept you for over an hour. If my listeners want to take a look at your Substack or your paid newsletters, how do they do so?
Yeah, I'm pretty active on Twitter. My handle is CES921, and I also host a bunch of my thoughts on a website. It's called the Aletha Narrative, and I write the Three Circle Investments newsletter on Substack. And I'm also, like he's mentioned at the beginning, I also provide macro consulting services to folks at Leduc Trading. So anywhere you'll be able to find me.